I have been around long enough to know that the stock market does not do its worst damage when the news is obviously catastrophic. It does its worst damage when the surface looks calm, the index looks resilient, people start telling themselves the danger has passed, and money is already moving underneath them faster than they can see. That is the kind of market I believe we are standing in right now. If you only looked at a few headlines, you might think everything is manageable. The S&P 500 is still hovering near record territory. Every few hours some new story arrives. That sounds reassuring enough to keep the crowd from panicking. People tell themselves the conflict will cool down, the tariff noise will fade, oil will settle, inflation will behave, and the Federal Reserve will somehow keep the whole machine upright. I would not build my future on that assumption. When uncertainty reaches extreme levels, most people imagine the danger comes from one dramatic event. They picture one crash, one speech, one war headline, one economic number, and then one clean market reaction. Real life is rarely that tidy. The most dangerous environments are the ones where several problems begin to reinforce each other at the same time. That is what I see now. You have trade policy changing fast enough that businesses cannot plan with confidence. You have energy costs that can still move the entire cost structure of the economy. You have a weakening dollar changing the way capital is priced across borders. You have inflation that refuses to behave the way policymakers want it to behave. You have a Federal Reserve boxed in by two bad choices, and you have a market that, at least on the surface, still wants to pretend this can all be ignored. That combination never leaves investors unchanged. It forces a choice. Either you react emotionally and get dragged around by the headlines, or you learn to watch what money is actually doing. Over the years, I have seen ordinary investors commit the same three errors whenever uncertainty spikes like this. The first error is the cash panic. People feel fear. Fear demands action. Selling everything and moving to cash feels like action. It feels disciplined. It feels safe. In truth, it is often the most expensive way to seek comfort. You sell productive assets after they have already been hit. You lock in losses. Then you sit in cash while inflation keeps eating your purchasing power. And when markets eventually recover, as they so often do, you are standing outside the door hoping for a second chance at the same prices you already rejected in fear. The second error is paralysis. This one looks quieter, but it is just as dangerous. People do not want to sell, but they also do not want to think. So they freeze, they keep every holding exactly where it is. Not because they have evaluated the portfolio and concluded it is still suited for the environment, but because they cannot bear to make a decision that is not patience, that is surrender. A portfolio built for one environment can become badly mismatched when the environment changes. If rates, inflation, energy, margins, and currency conditions are all shifting. Doing absolutely nothing without fresh analysis is not a strategy. It is drifting. The third error is the one that ruins people fastest. They chase the spike. Whatever has just gone vertical suddenly looks like safety, gold spikes. So they buy gold after the fear surge, oil spikes. So they buy oil after the move. Defense stocks run, so they pile into defense after institutions have already repositioned. They buy what just worked because their brains confuse recent movement with future opportunity. That is how the public buys peaks that professionals spent the prior phase preparing for. I do not like any of those three responses. I prefer a framework. You do not need a prediction to survive a market like this. You do not need to know tomorrow. S headline. You do not need to know exactly what Washington, Tehran, Brussels, Beijing, or the Federal Reserve will say next week. You need to know how capital behaves when uncertainty rises, when margins compress, when inflation changes sector economics, when the dollar moves, and when institutions begin rotating before the public understands the direction. That is the game. The stock market is not one big pile of interchangeable businesses. It is a collection of industries with very different exposures to the same shock. Some sectors get hurt first. Some sectors absorb the pain with a delay. Some sectors quietly benefit. And in every serious market disturbance, money begins moving from one pocket of the market to another long before the average investor recognizes the pattern. That is why I always tell people to stop asking only whether the market is going up or down. The better question is where the money is going next. In moments like this, I think in 4 stages. The first stage is the shock. That is the earliest phase. When the event hits, algorithms react, fear spikes, and the public starts doing foolish things, prices gap, volatility jumps, the headlines become louder than the facts. In that phase, you do not want to be heroic and you do not want to be impulsive. You want to observe. You want to identify which moves are emotional and which moves may be structural. The second stage is repricing. This is where the serious money begins asking questions the public usually ignores. How persistent is the oil move? How vulnerable are margins? Which companies can pass through higher costs? Which businesses depend on cheap capital? Which sectors benefit from government spending? How will inflation affect policy? What happens if the dollar keeps weakening? This is where institutions stop reacting and start repositioning. The third stage is rotation. This is where the real money is made. By the time the public is still arguing about whether there is a crisis at all, capital has already begun flowing toward the businesses and industries designed to live in the new regime. That move can last months. Sometimes it lasts years. It is rarely obvious at the beginning, which is exactly why it matters. The fourth stage is normalization. By then, the people who waited for clarity are late, the people who panicked are damaged, and the people who followed money flows instead of noise usually look like they had a crystal ball. They did not. They simply watched the right things. So what should you watch? The first thing is oil, not because oil is the whole story, but because oil touches nearly everything else. It is embedded in transport. It is embedded in manufacturing. It is embedded in chemicals, food distribution, packaging, logistics, travel, construction, and the final price, a consumer pays for thousands of things they do not even associate with energy. When oil spikes, the first order effect is obvious. The second order effect is what matters more. Higher fuel costs change the economics of trucking. Then trucking changes the economics of manufacturing. Then manufacturing changes the economics of construction. Then construction changes the economics of housing and development. Then the cost structure rolls through the broader economy with a lag. The newspaper may tell you the crisis cooled off because one number came down off the high. That does not reverse the embedded repricing already pushed into contract shipping, inventory, and future bids. That is why a single commodity move can become an economic pipeline. The next thing to watch is inflation. Not the lazy version of the conversation. Not simply whether one monthly print came in a little higher or lower than expected. What matters is whether the inflation pressure is demand-driven, supply-driven, or policy-driven, because those are very different beasts. If inflation is being pushed by supply constraints and energy costs while growth is already weakening, then central bankers do not get the easy answer. They do not get to cure the problem with a simple rate move and declare victory. They get trapped, raise rates, and they crush an economy that is already absorbing higher costs, cut rates, and they validate more inflation and more currency debasement. That is not a theoretical dilemma. That is the real problem facing policymakers when uncertainty, inflation, and weak growth arrive together. I have learned to assume that when officials face a choice between visible pain now and slower pain later, they usually choose later. That means they tolerate inflation more readily than recession. They may complain about inflation. They may promise discipline. But when the pressure is intense enough, they almost always choose the path that keeps the machine moving in the short run, even if it quietly damages purchasing power over time. That is why I never trust the comforting version of monetary policy. The next thing I watch is the dollar. Most investors treat the dollar as background scenery. That is a mistake. The reserve currency is not background scenery. It is one of the central pricing mechanisms of the entire global system. A weaker dollar tends to support hard assets. It changes the translation math for multinational earnings. It alters emerging market debt stress. It affects commodity pricing. It changes the relative attractiveness of cash, bonds, gold, and risk assets. When the dollar moves meaningfully, assets everywhere begin repricing, and when the dollar weakens into an inflation-sensitive environment, the public often notices late, because their account balances still look unchanged, while the purchasing power attached to those balances erodes underneath them. The next thing I care about is earnings. This is where many people become sloppy. They assume that if liquidity eventually returns, all stocks should recover in the same way. That is not how I see it. A stock is a claim on future profits. If the business model is being squeezed by cost pressure, weak demand, or higher financing costs, the stock can be far more fragile than the index suggests. Cheap money later does not automatically repair broken margins today. A company that cannot pass through costs is vulnerable. A company that depends on discretionary spending is vulnerable. A company valued on distant growth with weak present economics is vulnerable. If uncertainty is high and capital is becoming more selective, these are the places where repricing can get nasty. This is why I care so much about sector rotation. During serious disruptions, money does not just leave the market, it relocates within the market. That distinction matters. Energy often moves first when conflict and supply fears show up, but the longest-lasting opportunity is not always in the first obvious spike. Sometimes the smarter move is farther downstream in infrastructure, services, transport systems, storage, or the less glamorous businesses that benefit from sustained investment rather than panic headlines. Defense can move early too. The public usually chases the giant names after the first run. More thoughtful money often starts looking at specialized suppliers, components, software systems, maintenance, and the businesses that stay attached to elevated spending long after the first shock leaves the front page. Gold matters, not because I expect every investor to worship it, but because gold is one of the clearest historical signals of confidence trouble in paper systems. When governments run debt beyond comfortable limits, when rules begin changing, when real yields turn hostile to savers, and when central banks quietly continue accumulating metal, I pay attention. Consumer staples matter. Most people find them boring. I like boring when the world becomes stupid. Food, beverages, household products, and other essential consumption can offer a degree of resilience because people keep buying toothpaste, detergent, basic food, and similar necessities even when they cut back elsewhere. Some sectors that look safe are not actually safe in the way people assume. Utilities can struggle in inflation-sensitive environments. Real estate can become far less comfortable when financing, insurance, or input assumptions change. Consumer discretionary businesses can get hit hard because nice to have is the first category a household sacrifices when pressure rises. Airlines can get squeezed brutally by fuel import. Heavy businesses can get caught by currency and logistics. High multiple growth stocks can be punished, not because their stories are false, but because the discount rate and the margin outlook both move against them at the same time. This is why I do not like emotional investing. You cannot navigate this environment by asking which story is most exciting. You do it by asking a better set of questions. I think every serious investor should force themselves through a checklist like this. First, what phase are we in? Are we still in the shock? Are we in repricing? Has rotation already begun? Because your behavior should not be the same in all three. Second, what is happening to oil and energy costs? Not what one talking head claims, but what the move means for shipping costs and margins across the system. Third, what is inflation really doing, and what does that mean for the Federal Reserve if inflation stays sticky while growth slows? That is a very different world from one where inflation breaks cleanly lower. Fourth, what is the dollar doing? If the dollar is weakening, your old assumptions about cash safety and domestic only comfort can turn against you. Fifth, where is earnings risk concentrated? Which companies and industries are actually exposed to the cost pressures moving through the system? Sixth, what is the market not pricing yet? The biggest opportunities usually live there. Seventh, what is your time horizon? That one changes everything. If you are trying to trade next week, you should behave differently than if you are positioning capital for the next 3 years. Most investors skip this entire process. Then they wonder why the market feels like a trap. It feels like a trap because they are reacting inside a game whose structure they never bothered to understand. I have seen this movie before in different costumes after the 11th of September. Many investors froze. The broad market took a hit, fear spiked, and most people focused on the event itself. But the more important observation was where spending, security priorities, and capital flows would move afterward. The immediate fear trade was only part of the story. The longer opportunity sat in the sectors and systems attached to a new security regime. The same pattern showed up around major war shocks and energy shocks. People who sold everything often felt temporarily relieved and then permanently poorer. People who bought the first emotional spike often confused the beginning of a move with a durable entry. The more durable money usually went to the sectors that benefited from the second and third order effects, not just the first headline. That is why I always return to discipline. The goal is not to be dramatic. The goal is not to prove you are brave. The goal is not to predict the next tweet, the next ceasefire rumor, or the next official statement. The goal is to build a process that prevents stupidity. In moments like this, I want a portfolio that acknowledges reality. I want exposure to productive businesses. I want respect for inflation risk. I want selectivity around earnings quality. I want an understanding of dollar risk. I want dry powder, but not blind devotion to cash. And I want enough flexibility to respond to rotation without being forced into panic. If you are sitting with a portfolio built entirely for a low inflation, low rate, highly stable world, you do not need to panic. But you do need to re-examine if you are 100% in pure dollar comfort assets. You should at least understand the risk you are taking. If you are tempted to pile into whatever just ran the hardest, slow down. If you are hiding from every decision because the noise feels overwhelming, stop hiding and start analyzing. The biggest gap in markets has never been IQ. It has always been behavior. The institutions are not magic. They simply operate from frameworks while the public often operates from feelings. That difference compounds. A market like this can punish the undisciplined savagely. It can also create enormous opportunity for the investor who can keep his head, watch capital flows, and refuse to confuse certainty with truth. I do not know the next headline. I do know this: when uncertainty hits historic extremes, when oil, inflation, policy, currency, and earnings all begin colliding, money will not sit still, it will move. And if you do not know how to think about that movement, your portfolio becomes a sitting duck. I would much rather be early with a framework than late with an explanation. That is how I would protect my family's money, that is how I think about my own, and that is how I would advise you to think. Now,